Hey everyone, this is your Entrep Guru, Avinash Ramsabag, and today we're going to take a look at the statement of financial position. So first of all, the statement of financial position, otherwise known as the balance sheet, it shows the financial status of a business as at a specific date. It details the assets, liabilities, and also the equity portion, otherwise known as capital, and it reflects the accounting equation, and that is assets is equal to liabilities plus equity, otherwise known as capital. Now, in many instances, it's also reflected as assets minus liabilities gives us capital. So please note it can be also a variation of this accounting equation. The format of a statement of financial position, as we would see, the first thing that we have to take a look at is that it is divided into three main sections. And again, as I said before, it reflects that accounting equation: assets, liabilities, and equity, otherwise known as capital. What are assets? It is whatever the business owns or controls. And it is divided into non-current, otherwise known as fixed assets. And these are ones that are going to last us for more than 1 year. Now, please note that's just a basic definition of it. And we have current assets. These are ones that would last us for less than 1 year. We have liabilities, and this is anything that the business owes, right? So if we owe anybody any money, then it will be considered a liability. Now, in this case, similar to assets, it's also divided into non-current liabilities, and these are long-term, and this is what you would expect to take longer than 1 year to pay back. And then we have current liabilities, which we would expect to pay back within 1 year. And afterwards, we have our owner's equity, and that is any money or any resources that the owner has invested into the business. We take a look at the step-by-step guide. So first of all, we have to list our non-current assets. And what we look at in this case, some of the examples that we have are land, buildings, equipment, motor vehicles. These are the assets, again, as we said, that are expected to last us for more than 1 year. So for example, if our land is valued at 50,000, equipment is valued at 20,000, vehicles valued at 10,000. We add all three of them, and we would arrive at our total non-current assets of $80,000. Please note that sometimes we may have intangible non-current assets, such as patents and stuff like that. In that case, we can still put them in, right, under fixed assets. All right. We have our current assets, and these are, as we said, those are what we tend to have within 1 year. And in this case now, some examples would be cash of 5,000, accounts receivable, which are people who owe you money, $8,000, and inventory, which is what you have for resale, $12,000. In this case, when we add all three up, we arrive at $25,000 for our total current assets. So when we compute our total assets, it will be our non-current assets plus our current assets, and therefore we will have $80,000 plus $25,000, giving us a total of $105,000. Next, we move on to our liabilities, and first thing is that we will list our non-current liabilities, and these are long-term in nature. You would have it for beyond 1 year. Some examples would be a bank loan, noted as long-term bank loans, mortgages, bonds. Those are all long-term in nature. In this one, we have a long-term bank loan of $30,000. We also have our current liabilities, and these are what we expect to pay back within 1 year. And examples, as we would see here, are accounts payable. These are people who we owe money to, most of the times for supplies. And we also have short-term loans. All right, in this case here, 5,000 and 7,000 respectively. And our total current liabilities, therefore, are 12,000, right? Taking into consideration that 7,000 for accounts payable and the 5,000 for the short-term loan. Please note, more modern current liabilities would be things such as a credit card. When we have to compute our total liabilities, it will be our non-current liabilities added to our current liabilities, giving us 30,000 plus 12,000, which was 42,000. We move on to computing our owner's equity section, and this represents the owner's claim after liabilities have been deducted. Now, what that means is that this is what the owner has invested into the business in terms of his own personal resources. In addition, any money that has been kept back in the business when revenues are taken into consideration and when we minus expenses to get our profit, any of that kept back into the business belongs to the owner also. So, in this case now, equity can be broken down into what the owner has invested, 50,000, plus our retained earnings of 13,000, giving us our total equity of 63,000. Please note also that the other way that we can compute this is using the accounting equation of assets minus liabilities, which was 105,000 minus 42,000. So we're taking a look at how it would be if it is on an actual financial statement. Again, we put out the name of the business and the statement of financial position. Please note we put as at. What that means is that this financial position can change from day to day. So it can be different today and tomorrow it could be something different. So in this case now, again, as before, we have our total non-current assets adding up to 80,000, which was land of 50,000, equipment of 20,000, and vehicles of 10,000. We add to that our current assets, which are our cash of 5,000, accounts receivable of 8,000, and inventory of 12,000, giving us a total of 25,000. When we add those two figures, which would be our total non-current assets of 80,000 plus our current assets of 25,000, we get our total assets being 105,000. Our liabilities, in this case, our non-current liability of 30,000, added to our current liabilities of 7,000 for accounts payable and our short-term loan of 5,000, which added up to 12,000, gives us our total liabilities of 42,000. When we add that now to our owner's equity of 50,000 for the capital and also 13,000 for retained earnings, giving us 63,000, we will arrive at the same 105,000 that we would have gotten for our total assets before. So in this case now, we are using the accounting equation assets is equal to liabilities plus capital. So therefore, once we see that the two figures, 105,000 for our total assets, is equal to our liabilities plus capital of 105,000, then we have our balance sheet or statement of financial position being reflected. In summary, assets are characterized into non-current assets and also current assets. Liabilities are the same. We have non-current liabilities and also current liabilities. Equity represents the owner's interest after liabilities are deducted from assets, and the accounting equation must always hold true. Assets is equal to liabilities plus capital. Please note any variation of this equation also holds true. That's it for today. I want to thank you very much. Please don't forget to like and subscribe to the Entrep Guru. This is Avinash Ramsabag. Take care. Goodbye.